From the rise of DeepSeek to the uncertain impact of tariffs, 2025's market landscape is challenging historical patterns. But here's what's really intriguing. Despite these disruptions, my guest today says he's finding that stock returns could increase if tech firms maintain their trajectory. Are we witnessing a fundamental shift in market dynamics or just another chapter in a familiar story? We're going to break that all down for you and more right now on UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. So nice to have you join us today. My guest in the studio with me is Professor Jeremy Siegel. He's a senior economist at WisdomTree and also Professor Emeritus at the Wharton School of Business at University of Pennsylvania. Professor Siegel, great to have you in the studio. First time we're doing this together in a long time. Great
Right.
to have you.
Happy to be here, Anthony.
Yeah, happy to have you. Something that we talk a lot about where we are today, and I think in order to understand where you are today, you kind of have to look back a little bit at this historical context of the markets. When you look at, let's start with stocks versus other asset classes. How does today's market compare to what you've seen over your career in the last, couple of decades?
It's really not all that different. If you take a look at the long-term graph, the long-term return on stocks after inflation is 6.5% to 7% per year. I think it's going to be a little lower going into the future, but not much. It swamps bonds, swamps treasury bills, swamps gold. It is the best performing of all the traded asset classes, and I still think it will be in the future.
Yeah, I love this chart. It just lays it out. I mean, it's from 1802,
right,
all the way on the left. I mean, I'm surprised there's data that even goes back that far. But you can see, obviously, when you're looking at stocks. I mean, what's the average return on the S&P 500? 8 to 10% every year.
Yeah, and that's including inflation. Once you strip it out, it's 6 to 7. And by the way, 1792, I think, was when the New York Stock Exchange began. So yeah, we got it 10 years later than that, but we now have over 220 years of data. And the persistence of stocks through all those up and downs, I think, is a major message of my book, Stocks for the Long Run, and the data that I've studied.
Yeah. Yeah, I mean, obviously you've got your many years in academia. You're also, obviously somebody who's a well-respected investor and a research analyst. And I'm curious to know where you think about today. We've got, obviously, artificial intelligence is one of the biggest stories that we've seen in a few years. And specifically, a lot of conversation about DeepSeek, which is this AI software, came out of China. Valuations are anywhere between $1 billion to $10 billion. It's anyone's guess. But it has literally changed the game with their new R1 processor to it's less energy, it's easier to work. What are your thoughts on how these kinds of developments will at least affect the markets in one way, and also this historical trend that we're seeing of that upward value in stocks?
Well, it's a really good question because, in a way, and others have pointed this out, if we can make AI cheaper, this is going to help all the user firms, mom and pop, if you want to say, that are not tech firms, and it could be a challenge to those very high-end tech firms that get huge margins off of there. So it could be great for AI, but it might even be better for non-AI type stocks looking forward.
And one of the things I look at when I'm looking at things like AI is you look at the individual stocks, the Mag 7, and there's various degrees of weakness that have happened with a few companies over the last couple of days. And I ask this question of all the guests, is there room to grow within that tech space when you look at the Mag 7, the big names?
Oh yeah, there definitely are. I mean, because there's the producer and the users. Oh, we have a graph of the growth stocks versus the value stocks. And it's truly, this is a long-term growth going back to 1979. And you can see in the middle there's an internet bubble, and people say, oh my God, it looks worse now. But the important thing is that, in contrast to what happened in 1999, 2000, this big surge has been supported by earnings, and really on an over big basis. I don't think that they're at all overvalued. That being said, we have a close-up of that graph, and although you see the trend up, recently the narrative has shifted. You mentioned DeepSeek. There's talk now about, as you know, self-driving of the Japanese EV maker, BYD. There's a lot of talk about the commoditization of these AI, large language models. You're beginning to see a shift saying, you know what, I don't want to put all my chips in one basket.
Right.
I want to diversify out. I made a lot of money on these. I'm not saying they're bad stocks, but my studies are nothing stays on top forever, and you got to be aware that there's a lot of other potential winners that I think are going to mark the future of our markets.
Right. I read something that you wrote saying that the commoditization of some of this AI could be disastrous to some of the chip makers that are finding success today.
Yeah, I mean, the commoditization, of the high end is the threat. People think automatically if you use AI, that's got to be good for those AI makers. But if you study markets, it's the profit margin. If something can be commoditized and everyone does it, this is good for everyone, but it isn't necessarily good for the sole maker of those chips. So that's why you're beginning to see a rotation here, and I certainly wouldn't be surprised to see that continue in coming months.
Yeah, so essentially it's a bad idea to be a one-trick pony in this market, especially on the tech side.
It's always, bad to be a one-trick pony, especially for the long run.
Right.
You can be a winner in the short run, and then you stick too long to a theme. I've seen it again and again in the markets.
Yeah. Just to use a little colloquial language there for you, Professor Siegel. Thank you. When we looking outside the borders of the U.S., we can talk about things like tariffs, potential tariffs. But for today, I just want to kind of think about when you're looking at the diplomatic tensions and the volatile markets from the U.S. and across to the other side of the globe, international and EM. Do you see a change in stock valuations as you look across the globe?
Oh yeah, I mean, you take a look at Europe recently, even with the dust up, between Trump and Zelensky. Now maybe they have to come forward on defense and get their house in order over here. And we have a chart here of price earnings ratios of all the different country stock markets in the world, and the U.S. is the highest by far. Now, we are exceptional.
Right.
And we deserve the highest. But, when you have 14, 15, 16 price earnings ratio areas around the world, Europe has been one of them. You don't need much growth to get great returns when you have that valuation. When you have valuation like Mag 7 in the 30s, you got to meet and beat your target all the time. Good thing about the rest of the world, which has a price earnings ratio closer to 16, is they don't need that sort of growth to give you those superior returns.
But you're saying we need that here?
Well, I think what I'm saying is that that's important for international diversification. And I realize that everyone that's gone foreign, very few of them say, why should I do that anymore? Because, we can't beat the S&P. Let's put everything in the S&P. Well, history shows you there can be long periods, one country outperforms, but over the longer run, the diversification will pay.
Right. I mean, certainly from our view here in UBS and our Chief Investment Office, we still are optimistic on the outlook of the U.S. economy.
Oh, absolutely.
So you agree with that too, then?
Oh,
yeah.
yes.
And the Fed has quite a job. I mean, I don't expect, or at least we don't expect here at the CIO, that the Fed is going to start raising rates. They might be less dovish, maybe not. I don't think hawkish is the right word. What are your expectations?
No, I think really raising rates is not in the conversation. I mean, clearly there is worry about the tariffs that we have now, and the slowdown in this first quarter, which we're going to get more information as time goes on that. So now, really, what's come into the conversation again might be some drop in rates. I don't think it's going to be substantial. Because I think there's a lot of fundamental strength in this economy. So I don't think we're going to have a lot of rates. I hope we don't, because actually a lot of rate cuts means we're going into a recession. So you don't want that. You really want a healthy economy where the interest rate is normal. And by the way, normal interest rates means that long-term interest rate, 10-year bond, 30-year bond, or whatever, is above the short-term rates.
Right.
And that's something that, just recently with all the volatility, we've actually dipped below on that and hope to normalize that into the future.
Right. There was a little spike in the VIX recently, probably because of the fear of tariffs. But then you have Fed voting members. Austin Goolsbee, for example, said that he believes inflation is still on path to a 2% target. So I love the way you described that. It seems like the Fed knows what they have to do. We think 50 basis points here at UBS, probably likely.
It's very likely, and I wouldn't like to see more because I think that would mean too weak an economy given the strength. I'd like to see them, but 50 basis points as long as that CPI is down, and even with tariffs, remember only a one-time click upward, and it's not something. You have a 10-year bond, you're talking about 10 years, so don't get too frightened by some price increases that are short run and not long run.
Excellent. Professor Siegel, one last question. Where do you see the best opportunities in the market right now for investors out there who are looking at you and saying, I want to hear what he has to tell me?
I think don't put all your eggs in one basket. It's one of the oldest things. And don't put all your, despite the tech and how good it is, I see a time of rotation now, diversification, I think is going to be the name of the game in 2025.
Couldn't agree more. Thank you very much, Professor Siegel. What a pleasure. Thanks for coming through.
It's been a pleasure.
Excellent.
Thank you.
Good to see you. And thank you all for joining us. There's lots more information on our Insights website, ubs.com/views, from comments from our Chief Investment Office and great partners like Wisdom Tree. So take a look at that website. Plus, you can also take a look at all of our social media content. We're on LinkedIn, Facebook, and Instagram. You can follow us at UBS Trending on the Instagram channel for lots of studios content. And as always, if you have any questions about your portfolio or anything that Professor Siegel and I spoke about today, please make sure you are talking with your financial advisor. Until next time, I'm Anthony Pastori. Have a great rest of your day, and remember to keep your eyes on what's trending. We'll see you soon, everybody.